please hold on to your seats, and we can go from there. So without further ado, Swapman, go ahead and start.
Thanks, Bharat. So I'm going to talk a little bit about just general concepts in market making, and there's a lot of misunderstandings out there with traders about what exactly market makers do. So we're going to talk a little bit about that, and before I hand it off to Bharat. So market making, simply put, is providing liquidity, bids and offers in a market so that other traders can take liquidity. And they're mostly interested in securing reliable income. They're not just directional traders who want to go super long or go super short. Their game is to provide reliable bids and offers so that roughly half of the traders at any given time are taking offers and the other half are taking bids. And they want to just capture what's called the spread, the difference between the bid and the ask. And these are institutional players who are involved in the market making, and they are interested in the retail flows that people that cross the spread, because they want to take a long position or they want to buy a given asset, or if they want to take a short position and sell a given asset. And so I have a little example here on the slide of how a market maker sees a market. They see they put the bids and the asks there, and they're targeting a flow that roughly crosses the spread 50-50, so that they're just reliably generating income based on this spread. So somebody who's market making Ether dollar, for example, they want to set the bids and offers in such a manner that traders are, roughly half of the volume is hitting the offer side and roughly the other half on the bid side, and they just adjust with the market as well. And they're just trying to capture that spread. So there's this misunderstanding by a lot of traders who they get in a losing position and they like to blame the market maker. The market did something bad, and they say, oh, the market maker screwed me. But this is not really rational most of the time. Market makers aren't interested in throwing the market around. They want to have a nice, stable market where they're just earning that spread. So market makers aren't evil actors. They're not bad actors. They're incredibly important, and they are really the lifeblood of exchanges. So many of you guys, all of you guys, have traded on existing exchanges, and we've all experienced what I like to call empty book syndrome. And these are what we tend to witness, especially in token markets, ERC20 token markets, that exchanges, they put together a simple platform, they list 200 pairs, and what happens is they're all empty. You maybe have a couple of bids and offers here and there, and I don't want to name names of specific exchanges, but I'm sure you guys have an exchange or two in mind that represents this issue. But they just list all the products that they can think of, and there's not actually any liquidity already in the book. They rely on this concept that, build it and they will come, which is actually not a fair assumption in the markets, because you suffer from this chicken and egg problem. So the analogy I like to use is a nightclub. So if you have a nightclub that's completely empty and your friends want to go out on a Friday or Saturday, you're not interested to go if it's completely empty. So you want to go to a nightclub that actually has people there. You want to be able to have people to party with, people to dance with. But the question is, in the afternoon before the nightclub is open, it has to stay empty at some point. So they have to start with people there, and that attracts more people. And so what nightclubs actually tend to do, and I'll talk about this a little bit later, they incentivize people to actually come and party so that there's action, and then people come to join the action. So this empty book syndrome is basically, if you're a trader and you want to take a position, especially a leverage position, you're not interested to jump in if there's not much liquidity. Like, why am I going to take a long position if I can't reliably exit that position? So it's like a vicious cycle where there's not enough liquidity, so traders don't want to come, and traders don't want to come, so the liquidity never improves, and you get this empty book syndrome, where there's just all these products on the platform and nobody actually really trading. And it becomes more costly to cross that spread for traders who want to take a position. So who exactly are these mysterious market makers? Market makers they tend to be institutional players, so guys who have access to many different sources of liquidity. So not just some guy who's on an exchange and has a bunch of ether, has a bunch of dollars, and he's just putting bids and offers. It's much more complicated than that. So the most effective market makers they already have an inventory, and they have access to many different, a variety of sources of liquidity, not just spot exchanges, not just futures or derivatives exchanges, but they also have access to over-the-counter trading options, which are where you can actually do much larger block trades, and also they have existing inventory that they need to deal with, and they can sometimes get discounts if they're brokering deals between parties. And then one of the common plays are foreign exchanges. So you might be familiar with Korean and Japanese markets that often trade at a premium to Western markets. And that's because there's frictions in moving funds from one part of the one banking system to another. And market makers who are well connected and have solid liquidity, solid connections, they are able to exploit these price differences because they are able to move capital in ways that the retail and other traders aren't able to. So they can capture through all these different sources of liquidity. They're able to capture differences between the prices and just reliably make money. And this is a concept called arbitrage, where you have a fungible asset like ether or leverage token, and if it's selling at exchange A for one price, and you can buy it from exchange B for another price, then you can simply make money by exploiting that differential in between the exchanges. And if you're a large player that's able to move in and out relatively frictionlessly, then it's extremely profitable to just constantly run arbitrage between different price sources. And this ends up benefiting the market. It's not just when I say exploiting the price differential, it's not like they are exploiting people or exploiting the market. They are simply generating volume on these different exchanges, and there's people who have certain preferences on these different exchanges who are plenty happy to be filled. So the volume creates more volume, which leads to traders getting more interested to get in, and it helps overall markets and the liquidity in general. So why or how does an exchange attract a particular market maker? How exactly or why does a market maker choose to provide liquidity for an instrument on one exchange versus another? And the answer is pretty simple in legacy and crypto markets. Basically, when you have proper liquidity, as an exchange, you're able to generate more volume, which means more fees, which means more revenue. And without market makers, you're going to earn less. So if you're able to add more value, then the exchange is willing to share a portion of that with existing with the market maker who's helping to add value in the exchange overall. And this is often done through fee rebates. So market maker would get a special fee discount because he's adding a lot of liquidity and it's helping. So in comparison to normal users, they get a little bit of a fee benefit. Another form is to just make a fixed payment, like you pay them 100 ETH per week if they meet certain conditions. So if the exchange tells them, hey, you have to provide at least a 1% spread, you have to provide at least 100 ETH worth of depth, up to 5% on either side of the market. And then you'll earn this fixed payment that we'll offer. And then finally, there's revenue sharing, equity, and joint ventures, which a lot of exchanges, they work together with market makers in order to have a deeper relationship, because they are so critical to the success of the exchange that it actually becomes sensible to have a deeper partnership. So these are the standard ways that exchanges can incentivize market makers to be active and to not just provide the liquidity, but to actually generate the volume as well. And so that, in a nutshell, this is how market making works, and this is how exchanges try to get market makers on board. And then and now Bharat is going to give a bit more technical side of things and why, how exactly market makers, what their preferences are, and why they would get involved with one exchange versus another. So Bharat.
Hey guys, so I'm just going to continue the presentation where Swapman left off. Essentially, as you saw, for a market maker, their approach is very simple. They buy at a lower price and sell at a higher price, and the difference between those is essentially their profit. So as a market maker, they are on an average always buying low and selling high, and as long as there is plenty of volume, they at least mathematically they should be profitable, right?
Barath, can you make your screen in present mode, please?
Is that better?
Yes, thank you.
So what the market maker does is they find a very small edge and they repeat that millions of times. So a 0.01% edge after cost, if they have 1 million trades, that is 10,000%. In reality, a lot of edges are much smaller. They're much more fleeting. But the issue is that a negative edge can bleed money at the same speed. And when the market maker has to have certain abilities and certain capabilities in the exchange platform to adapt to changing market conditions. So when the spread is tight, the market maker needs a higher volume just to generate the same amount of profit. But when the spread is tighter, they expect a higher volume because now it's a lot more trades are feasible for users. The prices are more attractive. When the spreads are wider, they can make the same amount of profit on lower volume, but it also results in lower volume because a lot of traders look at the spread and say, that is not worth for me to trade. When there is high volatility and when there's high volume, the market makers will always increase the spread. And the reason is when volatility is high, their edge will, the edge can be lost. So if the market keeps going up, then there's only buyers. The market maker is now creating exposure on one side of the book instead of both sides of the book. Similarly, when the volatility is low, they can decrease the spread, hoping to encourage more traders to jump into the mix. So market makers have what are called strats, and strats are their way of adding intelligence to the way they buy and sell. The oldest strat is still in use, continues to work today, is just to move with the broad market. And you may have seen that when Bitcoin moves down or Ether moves down, all the tokens move down, all the other cryptos move down. So this is essentially what they do when they see the major instruments moving up or down. Regardless of the sentiment of this particular instrument, they will simply move in that direction. Nowadays, there's all kinds of algorithms and computers and high-speed, capabilities that you can do. You can add some more intelligence based on market data, your exposed positions, your risks. You listen to changes in volume. and you can adapt your, you can use it as a factor in your trading strategy. What any market maker or anyone who trades the market will tell you, that all edges are fleeting. So today you have an edge, tomorrow that will become smaller and smaller and it will disappear. And you need to change your strat all the time. It needs to be constantly refined. You will find the market changes over time, and the things that used to work will stop working. And it will change from a big positive to a small positive, and it will go to negative. So the market makers need to be able to adjust this all the time. So why does the edge change? One is simply there are new entrants. And if there is a new entrant who can react quicker and offer like a tighter spread than what you could, he will get all the trades. Or if he can cancel his orders faster, then when the market moves, their orders won't be filled at adverse price. Yours will be filled because you were too slow to cancel and move the orders. So the speed of updating is extremely important in your profitability. If you are slow to update your orders, if there is simply a lot of load on the exchange, you cannot cancel or create new orders on time, your orders are stale and they will be filled at adverse price. You lose the edge. So if the market is going up, you really want to increase your ask. If you could not increase that in time, it gets filled at rate, and you get a little less than you would have, and that is your edge whittling down, right? And last is hedging friction. So if you are long in one space and you feel that in one exchange or one area, you feel the exposure is too much, you really want to hedge it somewhere else by selling it on a different exchange. And when you move assets from exchange to exchange, the friction also adds cost, in the sense that you may not get the favorable price in the other place, or there is cost to actually time and all these other costs to move things around, and that will also damage your edge. So in addition to the edges, there are risks the market maker takes. Market makers have a lot of money on these exchanges, and their risks are much, much higher than you or me. The biggest risk is custodial risk. What that means is that in crypto, you have money on an exchange, it gets hacked, it's all gone. Tomorrow, your entire business, all the profits you accumulated, all your hard work, all your intelligence, the code you wrote, all of that is for nothing, because everything you worked for is gone, right? And this means the way many market makers address this is they spread their capital on different exchanges, hoping that if one exchange is hit, they only lose 20%. It's a blow, but it doesn't kill them. And many other market makers simply keep a reserve, and they only put a small amount of their capital on an exchange. So most of their crypto is just being held. Nothing is happening to it. So they won't be able to deploy their full reserve. The next, of course, is fraud risk, which is not really realistic, in the sense exchanges take very, very good care of their market makers and make sure that they're very happy. But theoretically, it is possible that the operators of the exchange are able to trade in a way favorable to themselves against the market maker because they have more information. Instability risk is when the price is moving not in accordance with the markets, with other markets. So let's say you have a Ether or a token, and it is kind of steady on other exchanges. On your own exchange, it just keeps jerking. The price starts just jerking around, and this prevents. This introduces a lot of risk into the ability to calculate your to actually make offers and bids properly, and you could end up buying high and selling low because the price is just chopping around. Latency risk is the any sort of change in the speed or any slowness in your ability to update or cancel orders. It's simply going to cost you a lot when the market is moving, when there's a lot of volume and the market is moving fast. And this is when on a centralized exchange, you can maybe get cancel your orders in 50 milliseconds or 100 milliseconds. It is still pretty slow because the standard on a fiat exchange is about is under 100 microseconds. And when you are doing it at 1,000 times slower at 100 milliseconds, you are already incurring the risk of being in an unfavorable position. On decentralized exchanges where everything happens in block time, 15 seconds, 30 seconds, the loss becomes even more intolerable. And what we do is we address these risks for the market maker to make it attractive for our platform. So to address custodial risk, we have a non-custodial model. We have fraud proofs that detect any sort of wrongdoing by the exchange or any actor who participates in the exchange. Instability risk in this example is for derivatives. We use a median index instead of a volume-weighted index. And to deal with latency risk, we take all the critical path of the blockchain. So to give to put actual numbers into latency risk, if the rate of change is 0.1% and you have 20-second block time, then 20 seconds, by the way, is just one block in Ethereum. You really, to have some sort of degree of confidence in finality, you need more blocks than that. But just being optimistic here, you still have a risk of about 2% of your capital, and 2% of your whatever you have on the books. And 2% is very huge for a 1 second movement, and that's what you're risking. When it goes down to 200 milliseconds, you see the risk is a lot smaller. It's still very high. 0.02% is still very, very high from a market maker perspective, because remember, your edge is much smaller than that. You need to have the risk smaller than your edge, much smaller than your edge. Otherwise, it does not make sense to market make on such an exchange. You will bleed all your money very fast, right? When if you look at the crypto, if you look at tokens, they can move much faster than 0.1% a second. They can move 0.5%. Some of them have moved even 5% or more in a second. And when that happens, you could really lose a significant chunk of your capital just because the price is moving so fast. And the longer the finality and the faster the change, the more you're exposed. So since you cannot control the change per second, you have to minimize the seconds to finality for it to be attractive to a market maker. And this is why we believe a lot of DEXs simply won't be attractive to market makers. The market makers will simply bleed out. So if you look at all the DEXs out there, they have the 4 models that we have showed here. The first model is a reserve. The DEX essentially is a big reserve in a smart contract. They have assets that are in reserve, and you simply trade against the contract, and the contract adjusts the price based on whether you're buying or selling. This requires very, very careful calibration of the price change. If there's even a small mistake, then the funds can be drained through a good arbitrage bot. And what happens is, as you know, the edges and change all the time, and strats need to be refined all the time. So a reserve AMM model is essentially saying, I have one strat and it's going to work all the time. And as time passes, you will see most of these DEXs will simply get bled out. The second is an Oracle-based model where there is a reserve, and the owner of the reserve will set the exchange rate. He'll make a call into the smart contract and update the exchange rate. This is even more susceptible to arbitrage, because you can only update the price once per block. This means when the price moves in the external world on a centralized exchange, you have 15 seconds to drain as much as you can from the reserves. And both of these exchanges are susceptible to front running, which means you see a trade. When you see the real market in the fiat world in the centralized world move faster, you can simply pay a higher fee and match orders that are already matched to someone else, right? So right now there's insufficient volume and insufficient that the friction is high enough that this doesn't happen. But if ever these exchanges become large enough, this is going to be a problem. And the last model, the third model, is the off-chain book on-chain match, and these are, these have even more issues. For example, when you say that I'm going to have some sort of relay or some sort of order indexer and it's peer-to-peer, the same order can be put on multiple relayers, and many matches will be attempted, only one will succeed. And this is easy to just poison all of these with orders that will never end up settling, right? And I think a big problem with those models also is that you need gas to cancel if you want to cancel fast, or you have to depend on some sort of expiry, which unfortunately is only useful when the market is not moving. The market moves fast, you need to update that fast. And if it takes a block to cancel the order, if it takes gas, if it takes 15 seconds, that will never be a high volume model. So that only leaves at this point hybrid model, where all of these operations are off-chain and only the custody is on-chain. This is the only model I feel that can actually scale to the needs that can actually be attractive to market makers. So these are some financial engineering issues that DEXs sort of gloss over, and which also prevents them from being attractive to market makers. Many DEXs sort of do a model of you can exchange any token with any other token. For example, you can change Binance token with the Golem, or any hundreds of tokens with any other 100 tokens. What this means is the liquidity is spread over n times n squared pairs. So if you have 1,000 tokens, your liquidity is spread over 1,000,000 pairs. Versus if you have against a medium of exchange like Ether, you only have n pairs. That's a lot more focused liquidity. In general, this kind of market doesn't exist in the traditional markets. So you never think that I will sell my motorcycle and buy a computer, or I will sell. I will exchange directly. You won't go looking for such a trade. Similarly, you won't try to exchange your Intel shares for Apple shares. What you do is you sell one and you buy another. And the reason is the pressures that make you take the trade, they don't occur simultaneously, right? So you see an opportunity to sell, you want to get out of something because you feel the trade is complete, you will get out of that, and you need to sort of hold until you find an opportunity to enter into something else. So 1 into n pairs usually are a much better use of liquidity. And the only market where you have these arbitrary pairings is the foreign exchange market, which is the biggest and the most liquid market. And even there, 87% of all trades go through USD, right? So it's a very hard thing to do for something like crypto. Gas to cancel, one of the issues with the gas to cancel is that in a large move, everybody tries to cancel their orders. And for your cancel to go through, you'll end up paying more gas. And once everyone knows that, everyone essentially just tries to pay so much gas just to make sure that their order is canceled and not filled at a poor price. And this actually makes it infeasible, in the sense it bleeds out your edge completely, and the exchange itself won't be able to create a lot of trades, because there are so many cancel orders that are simply clogging the system. And we already touched on unverified orders, and so the last one is, when you do on-chain matching, there's actually a physical maximum on how much you can scale, how much the exchange can scale and the trades can scale. And this is an example for Ethereum with current parameters. So this is for all DEXs combined on Ethereum. This is assuming that Ethereum doesn't do anything except decentralized exchanges, no other usage. There is a 8 million gas limit per block. And approximately, if you look at all these DEXs, they take about 100K of gas per execution. It varies from 40, 50,000 to 120,000, but as a median, it's about 100,000 gas, which is approximately 5 transactions per second, which is approximately 430 to 1,000 transactions per day if cancels are free. This is about the size of Coinbase. So all DEXs that are matching on-chain put together, if the only use for Ethereum is nothing but DEXs, will not grow bigger than Coinbase. That's essentially your physical limit. So all DEXs put together, doing nothing else on the, having complete allocation of the Ethereum bandwidth, this is the maximum they can do. Okay. Now, 90 to 98% of orders are cancels because of the way the price moves. So if you have a system where canceling costs gas and it costs transactions, you are looking at 43,000 transactions per day, which is very, very tiny, even in the crypto world, and it's microscopic in the whole realm of trading. So so essentially, the only way DEXs can really scale into anything resembling the size of the traditional market is they have to wait for Plasma or one of these scaling technologies to really, right? And even then, we don't know, how quickly they can adapt to it. So just to close the discussion here, at LEVERJ, we believe that unless you have the safety, the liquidity, and the speed of trading like a centralized exchange, the fact that you have decentralized custody won't mean much. So we want to have absolutely everything. We want to have the enjoyment of trading, the liquidity, the volume, and at the same time, we want the safety afforded to us by blockchain technology. So that is essentially the end of the presentation. At this point, I'd like to make an announcement. Let's see if I can change my window here.
Should we open for questions maybe from them before you make the announcement or after?
You could do either way.
Let's take questions about general market making at this point.
Okay, so Peter's asking about the latency risk for market makers. Will they have a form of prioritization on orders for them? So basically the matching, if I may, Bharat, just take this and you can correct me if I'm off, but the market is going to be price time priority for all the orders. No market maker gets any special privileges when it comes to that. The only so-called edge would be fee rebates for the market makers, which are an incentive to get them to provide liquidity. But there's no special front running, any kind of cheating, any kind of bullshit like that. It's a fair, open matching engine that just treats every user equally and matches based on price time priority.
Yeah, that's correct. And we also have a fraud proof that detects violations of price time priority. So if the exchange gives unfair priority to someone else, it can be detected by all participants, and you can also create a cryptographic proof that there was a violation. This is part of our fraud proofs feature.
All right. Bill is asking in the chat, the fee rebates are coming by way of providing the market makers with LEV, which they can stake. So we haven't resolved specifically how these rebates will be provided. That would be one mechanism, is to provide them with LEV, even just loaning them LEV and allowing them to stake and to receive the FEE tokens, which would cover the fees. That would be one mechanism, or we could just, the classic way the centralized exchanges will do it is just mark flag the market maker's account so that it's charged less fees versus others. So there's different ways this can be achieved, and we have not decided specifically on one method, but that's definitely an incentive that market makers would want. So one way or another, we're going to provide it.
Okay. Well,
So
there's no more.
Yeah, it doesn't look like there's any more. Oh, so would there's one more question, at least one more. Dex guy says, would the market makers be barred from selling LEV if they are given some as an agreement to provide liquidity? This is again, this is getting detailed, and we're not even sure if that would be the way to incentivize this through LEV tokens. It could just be a simple reduction in the fee charged over the platform, or it could be an ETH, or whatever is suitable for a given partner that we have. So I don't think we can commit to say that they will be barred from selling the LEV. I mean, I mean, we could set up some kind of mechanism where we are in custody of the LEV and just simply transfer the FEE tokens from the staking over to them, which would essentially be barring them from selling LEV. So this is another issue where we just have not settled on the specific. And the solutions might vary from market maker to market maker. So we're not going to simply have one single market maker. There's going to be multiple. We already have multiple that we are involved with, and so it really depends. But so Bill has a follow-up of how does it work with what they are required to do. Well, the fee rebates come on condition that they meet the requirements, right? So they have to provide minimum spread, minimum depth. We'll have it's not just a free lunch for them. They have to earn it. Yeah, so basically, so you also say what kind of contract do they have to sign regarding requirements. I think I covered that. Basically, it's just you must 75% of the time for a given day you have to provide X% of a spread of bids and offers with Y% of depth, and that those ensure that they are meeting these requirements. And if they don't meet those requirements, then they they lose their rebate or lose the contract for however way we choose to incentivize them. But we would, they would have a certain account. We would know who the market makers are, so we can see what they are doing, and therefore we would be able to monitor and hold them accountable to make sure that they're providing proper liquidity for you guys. All right, cool. Okay, Bharat, I think that's we're good on questions now. So why don't we get on to the main event for the announcement? Go ahead.
Yeah. Right. So I have some excellent news to share. We have partnered with. Can you see my screen?
Yes, it does show. Yes.
Yeah. We have partnered with Smart Contract Japan to provide market making on the LEVERJ platform, and we've signed a memorandum of understanding for them to provide market making on LEV tokens, ETHUSD futures, and any other ERC token as and when we come to an agreement. This is a very broad understanding, and we will push out this blog post soon. But it's a way, if you guys don't know, Smart Contract Japan is one of the biggest OTC providers for crypto, the biggest in Japan and one of the biggest in the world. And this is a very exciting development. We believe that this is a great opportunity for both of us to grow in this field and make LEVERJ a great platform. Any questions? Okay, looks like everyone is happy with it. Yeah. Okay, I guess if there are no other questions, we can terminate the presentation and catch up on Telegram.
All right, thanks a lot.
Great. Thanks, everybody.
Thank you. Bye.